Welcome to This Explainer. Today, we're diving straight into Rogers' Q2 2026 earnings report. And let me tell you, we're turning some pretty dense financials into a really gripping strategic story. If you thought telecom earnings were just about, cell phone towers and internet cables, prepare to be surprised. We're looking at a company that is radically redefining its identity, using an incredibly reliable cash engine to build an absolute powerhouse in the world of sports and entertainment. So let's unpack exactly how they're pulling this off step by step. Okay, right off the bat, let's look at this massive number, $4.35 billion. That is pure cash, by the way, and it represents the staggering amount Rogers is throwing down to acquire the final 25% minority stake in MLSE, Maple Leaf Sports and Entertainment. To put that into perspective, you could literally buy a small island nation with $4.35 billion, but Rogers is using it to secure full control of a sports empire. It's a monumental deal closing in the fourth quarter, and it's exactly the kind of price tag that makes Wall Street stop and stare.
So this naturally brings us to the absolute biggest question of this whole explainer. Why on earth does a company built on cell phone plans and home internet want to completely own the Toronto Maple Leafs and the Raptors? What's the actual connection between your monthly wireless bill and a seat at a hockey game? It's a fascinating pivot, and we really need to understand it to grasp where the entire media and telecom landscape is heading.
To find that answer, let's kick things off with Section 1, the blockbuster sports play.
Take a look at this. What's super interesting here is how CEO Tony Staffieri connects the dots. He explicitly ties their communications network directly to top-tier sports content as the ultimate key to unlocking shareholder value. He's not looking at these as two separate side businesses. To him, it is one integrated ecosystem. You have the pipes delivering the content and the premier content itself, all brought together under one roof to create a competitive moat that is practically impossible to cross. And we aren't just talking about a single sports team here. This deal gives Rogers 100% ownership of a sprawling, culturally dominant live sports and real estate empire. You've got the NHL, the NBA, Major League Soccer, the CFL, and the physical real estate of Scotiabank Arena. When you add all of this to their existing ownership of the Toronto Blue Jays, the Rogers Centre, and the Sportsnet network, you realize they aren't just participating in Canadian sports media. They basically own the entire board. And this brilliantly shows exactly why they want it all. Media revenue absolutely exploded this quarter, up an incredible 53%. We're talking a jump from $757 million to $1.15 billion. Now, a huge chunk of that was driven by consolidating MLSE's financials and packed crowds at Toronto Blue Jays games. Actually, they had their best second quarter attendance since 1994, operating at over 95% capacity. But even if you strip out the impact of MLSE, their organic sports and media revenue was still up 13%. Live sports is the ultimate premium content, and it's driving massive top-line growth. But, how exactly does a telecom afford a $4.35 billion all-cash deal? Let's zoom out to Section 2, the big financial picture, to see how they actually fund this. The crucial takeaway here is that the broader Rogers business is an absolute cash-generating machine. They pulled in nearly $1 billion in free cash flow in just 3 months. Total service revenue hit $5.05 billion, up 8%. And adjusted EBITDA, which is a great measure of their operating profitability, hit $2.44 billion. That is the sheer financial muscle that allows them to take these massive swings in the sports world. Now, a huge reason that free cash flow is up 6% comes down to a metric called capital intensity, which plummeted to 12.4%. That is literally its lowest level since the first quarter of 2008. In everyday terms, they're pacing their ongoing projects slower and keeping building costs in check. Less cash going out to build infrastructure means more cash staying in the bank to fund these mega deals and pay down debt. Now, if you were skimming the earnings report and saw a $726 million net loss on the books, don't panic. Seriously, it was just a non-cash paper loss. Because they agreed to buy out the rest of MLSE, they had to revalue a liability on their books from $3.3 billion up to $4.35 billion. That creates a huge accounting loss for the quarter. But operationally, their actual adjusted net income, stripping out those one-time non-cash items, actually grew by 3% to $640 million. The underlying business is highly profitable. Okay, let's move on to Section 3, the telecom engine. These are really the unsung heroes making all of this possible. Unlike that explosive 53% growth in media we just talked about, the massive wireless and cable divisions both chugged along with a slow, steady 1% growth. Sure, it sounds a bit boring compared to pro sports, but this boring telecom side is the reliable ATM funding those flashy teams. Wireless service revenue was perfectly stable, while cable service revenue grew 1% thanks to retail internet subscriber growth. This predictable performance provides the exact foundation they need. This underlying engine is just incredibly efficient. They added 40,000 mobile phone users and 17,000 retail internet subscribers this quarter alone. But here's the kicker. They dropped their postpaid mobile phone churn to 0.94%. That means, remarkably, less than 1% of their contract customers are leaving each month. That is a huge deal in telecom. And thanks to higher equipment margins, they pushed their wireless adjusted EBITDA margin to an impressive 66%. They're retaining customers beautifully. So, with the core engine humming along and a new sports empire secured, what is the ultimate endgame? Let's wrap up with Section 4. Future outlook and strategy. Even with some market uncertainty and heavy competition, management is completely reaffirming their confident 2026 outlook. They are projecting up to 5% total service revenue growth and between $4.1 and $4.3 billion in free cash flow for the entire year. That is a mountain of cash they intend to use to aggressively pay down debt and keep their balance sheet rock solid, ensuring these big buys don't jeopardize their financial health. And all that cash fuels a very specific 3-step monetization playbook. Step 1, buy that final 25% of MLSE in the fourth quarter. Step 2, bundle it with the Blue Jays and Sportsnet to create a mega portfolio, let's call it Rogers Sports. And finally, Step 3, over the next year, pursue the sale of a minority stake in this newly consolidated juggernaut to third-party investors. It's a massive play to unlock hidden value for the company. So, as Rogers essentially leverages the cash from your monthly cell phone bill to build a global sports and media juggernaut, it leaves us with one big question. Will this ambitious telecom meets sports synergy completely redefine the future of entertainment, or is a telecom giant straying a little too far from its roots? Thank you for tuning into this explainer, and we'll leave you to ponder exactly who really owns the game.